All right, this is a sector analysis of the energy sector, February 2022. And we got quite a bit to choose from. I'm going to try to narrow this down as easily as I can. We're currently in Valero, which is also the sector MVP. EOG is part of the M score portfolio, which has performed really well more recently. But there's also the matter of the up move portfolio as well. And we need to kind of see what's in that portfolio as well as the down portfolio, because the down portfolio is kind of what we're following. So let's take a quick look and see what's there, and that'll give us some more options as to what we can look to. So up moves, Valero, that's where we are, so that's good. Got that out the way. Let's take a look now at the down moves. EOG is in the down moves, so that's really good. And we know that EOG was also part of the M score portfolio as well. So it looks like EOG, Valero, and trying to grab another here. Um, we did talk about beta a little bit, but I think we're going to stay away from beta. The standard deviation is not a horrible way to go, but um, I want to stay as close as I can to the down moves. Honestly, looks like Valero is also part of the down move standard deviation portfolio. Another best performer here. Let's see. These are betas. All right, here we go. M score, ELG for that one, and then M score standard deviation was the other, and we have ELG for that one. So what we're looking at then is we're going to look at Valero, ELG, of course, and then we'll take second, or actually sector leader IMO, which I don't know anything about. So it's going to be really interesting to dig into that company a little bit. All right, so we got Valero, we got EOG. Oh, wait a minute. I just realized I need to click off all of this stuff. There we go. Uh-oh. There we go. That's better. Okay. Now, we got Valero. Got EOG. And we have IMO. Really interested in that one because I don't know anything about it. All right. Did I not click the button? Maybe I didn't click the button. Let's do it again. No, I did. There we go. All right. So let's just go down the list here and compare these. So as of current price, all three of these are investable. We can't invest in anything that's more than $150. As far as dividend, Valero beats out the rest of these guys by quite a bit. So there's something to say about that. The PE ratio much lower for EOG, really high for IMO. I imagine that's because the stock price has moved so much so fast just recently. Um, Average PE is 40 for IMO, which means that it's historically high anyway. Um, ELG is negative, and Valero is about one. I'm really surprised that Valero is not negative, because Valero has had negative profit for a while now, um, and it looks like Valero, as of late, has gone way above its average PE, whereas IMO has not. And so that means that technically, Valero at this point is more expensive than both IMO and ELG. ELG, again, showing what I have to imagine are negative profits to get a negative PE. All right, net profit for ELG, much higher than the rest of these guys. I imagine that's because it's probably a different business altogether. Again, I don't know anything about ELG or IMO, so I'll definitely have to look into those. Valero, I know, is a gas producer, so I don't know. I don't know. All right, let's see. Return on assets, much higher for ELG. Again, may have something to do with the business that they're in. Valero, much more cash on the books. We already talked about that. That's something that we definitely want to take a look at. And then cash to debt, much higher for ELG, simply meaning that even though Valero has more cash, ELG has less debt. And I know that Valero has made improvements just recently, getting rid of something like $1 billion worth of debt. But um, again, ELG still beats them out there by a lot. And then shares short. This is interesting. So Valero is 3.5%. And so what this means is that there's a lot of people out there that think that Valero is overpriced. Matter of fact, they're betting on Valero stock price to go down. And that can mean one or two things. It can mean that someone knows something that we don't, and Valero price really will fall drastically, in short order. Or it means that these people are completely wrong, and when the stock price does rise, they're going to have to purchase shares to close their positions, which is going to make the stock price rise even higher, even faster. So I think there's something to look at there as far as short interest goes. ELG and IMO are about the same. Um, Looks like all three of these guys are, right at about what their highs have been. IMO is further off their highs than everyone else. That's interesting. Um, and then IMO is way off its low, which means basically this stock price has come from a further um, ways away. Again, has a lot to do with the higher PE, but again, relative to itself, is not that high. It's usually this high, right? And again, that may have something to do with the business that they're in. We may look at their peers and see what their peers' PE ratios are. If they're about the same, then we know that's normal, right, for their industry. All right, here we go. Alpha. Valero beats all these guys out in Alpha. We know that Alpha is not necessarily the best place to be, but when the market is doing well, these Alpha companies tend to do well as well. All right, up moves. Valero beats out the rest of these guys in up moves. We know that the up move portfolio has performed the best more recently, trailing 12 months. And then as far as the down moves go, it looks like Valero and ELG are tied. And then the beta goes to IMO. So when the stock market is not doing so great, this particular company will perform better than the rest of these guys. Again, looking at the performance of the beta portfolios more recently, there's some, the worst performing portfolios have been betas, but there was like a smattering of beta in some of the better performing portfolios as well. So Hard to say, but I'm gonna have to just kind of skip that one, and say that maybe even having a worse beta is better right now. All right, and then the 1 month return again, it's kind of all over the place for the return portfolio, but it definitely has not been the best performing at all. Um, and so looks like ELG and IMO are kind of tied there. Valero, um, again, having the better performance, but when you go back and look at our table, we know for sure that ELG and IMO have performed better than Valero over the last 12 months. All right, volatility, and again, just to explain too. So this 1 month return is coming from 3 years worth of numbers, not including current market movement. So this goes from I think June 2021 to something like July 2019, I think, or something like that. So in 3 years past, Valero has outperformed these guys, right? But more recently, EOG and IMO are outperforming Valero. All right, and then so volatility is about the same. That's the standard deviation. And the M score, EOG, of course, beats out the rest of these guys by a lot in the M score, and that has everything to do with the debt. Okay, um, everything to do with the debt. Um, Again, that may not mean a whole lot depending on the industry. So let's do that really quickly because I am curious as to what exactly they do. All right. American Energy Company, hydrocarbon exploration. So that's oil, right? It's organized in Delaware. Okay. This isn't telling me a whole lot. But it says hydrocarbons. So that's oil. Oil and natural gas. Oh, it used to be called Enron. Ah, that's cool. Okay, so yeah, so natural gas and petroleum, and then oil. All right, so there you go. So I mean, it is a different business than Valero because Valero is strictly gasoline. These guys are oil. Now let's look at IMO. And so now I'm thinking, you know, so what does that mean when you have an oil company that doesn't have a lot of debt? Um, does that mean that they can take on debt to, spend on more exploration or, I mean, Imperial Oil, Canada's second biggest oil company, and it's owned by ExxonMobil. Interesting. Interesting. Okay, so IMO is basically ExxonMobil in Canada. All right, so that's really something. And so again, we're talking about EOG and IMO being very fairly matched as far as their comparisons here. So again, EOG much better debt, which is good. Okay, return on assets much better. Net profit much better. PE, yeah, hard to say. I don't know there. 3% dividend. And so for me, this comes down to we know we want we want the up moves, right? We know we want the down moves. We know that the M score um, is a current indicator of where the market is, not necessarily where it's going or where it's been. Well, yeah, to some extent where it's been, right? Um, and so the question becomes: do we pivot from the down move and go into um, you know the M score? And my thoughts have always been, if it's not broken, don't fix it, right? Um, a lot of what I do and why I do it is so that things don't get messed with very much. You want a system to work and continue working without you playing with it, right? And so that's the reason why I'm only updating this thing once a month. I don't even want to look at it the rest of the month because I don't want to be tempted to go in and play with stuff, right? You want everything to just work the way it's working. So once a month, meaning that if there's a stock that's up 20% in the middle of the month, we can't go in and sell that stock just because it's up 20%, right? We're going to wait until the next month on the second to take a look at it. If the stock is down 5% on the second, well, guess what? It is what it is. We're just going to hold on to that position until at some point when we are updating the portfolio, we are in a position to possibly sell that position. Same thing goes for the portfolios that we follow. It's a lot of fun to look at, kind of like I said, what's working, where the market is going. But we made a decision at the beginning of our fiscal year to go with the down moves portfolio. So that's where we're staying. At the end of our fiscal year, we're going to reshuffle everything, get a brand new basket of stocks, and we're going to look at this all over again and decide, okay, what portfolio are we looking at now? What has performed the best over the last year? And then, if we need to pivot, then we'll pivot then, but we're not going to pivot now. So we're going to stay with Valero. ELG is interesting. IMO is definitely interesting. The ExxonMobil of Canada. So at least we know a little bit more about those companies. But again, just based on up moves, is the best 12 months trailing portfolio. Down moves is currently where we are and best performing over the last year and a half. That is Valero. Valero has a better alpha, meaning that it's going to perform better when the market is doing better. And we know that the energy sector is outperforming right now. The fact that Valero has a larger short interest is a bit concerning, right? But that also goes to show just how outsized the performance for Valero has been, right? And it really has been up and down a lot. But it's also a good thing because there's a lot of premium in the options market. I haven't looked at it yet, but I'm pretty sure if I go out into the options market, I'm going to be able to make money on buying Valero a lot cheaper than where it is now. And so we're going to stick with Valero.